All right, let's just jump right in. For the last 3 years, the entire story around AI has been about one thing and one thing only: hardware. We're talking chips, data centers, power grids, the whole shebang. But here's the thing. While everyone was watching this hardware supercycle, a massive pivot began. And it was signaled by a corporate event that, honestly, most people just dismissed as noise.
And this is the number that has everyone completely mesmerized. $602 billion. That is the projected capital spend for the big hyperscalers, your Googles, Amazons, and Microsofts in 2026. A number that just screams infinite, unstoppable demand for AI hardware.
And this is where the story really gets interesting. Because that whole narrative, the one about endless hardware growth, well, it's on a collision course with the hard, unforgiving limits of actual physical reality. The smart money, it's already moving. This great rotation from silicon to syntax, from hardware to software, it's happening right now, just beneath the surface. And in this explainer, we're going to show you exactly where that money is going, and more importantly, why. But here's the hook. The real secret, the signal that almost everyone is missing, isn't just about software getting its moment. No. It's about a critical, fundamental mistake that pretty much 99% of investors are making with hardware stocks right now. And I'm going to reveal exactly what that value trap is at the very end of this. So, to really see this shift, we have to start with the first big truth, understanding exactly why the hardware party is, well, kind of winding down. Every major tech cycle in history follows this exact same pattern. It's uncanny. First, you build the infrastructure. Back in the 90s, Cisco built the plumbing for the internet. Then Google came along and filled it with value. In the 2000s, Apple built the iPhone. Then the App Store economy filled that. And right now, we are at the Cisco peak of the AI cycle. The hardware has been built, and the real value is about to shift to whoever figures out how to fill it. And if you're paying attention, the data is already showing some cracks in that perfect hardware story. Nvidia's growth still looks massive, but it's slowing down. And in the market, it's not the speed that gets you the big stock multiple, it's the acceleration. When that growth slows, multiples get crushed. You're seeing margins tighten, their pricing power is fading. These are all the classic signs that the easy money has already been made. And that brings us to what might be the single biggest, most underappreciated risk facing the entire hardware sector next year. You just can't argue with physics. You can't plug a gigawatt-scale data center into a power grid that doesn't exist. The wait times are stretching out for years. We've got shortages of critical parts like transformers. And the risk here is brutally simple. If you can't build the data centers, you stop ordering the chips. It's that simple. And that creates this huge air pocket in hardware demand, a problem that, by the way, software companies just don't have. So, right as hardware is slamming into this physical wall, a completely new type of software is emerging to basically pick up the torch and run with it. And listen, this isn't just another buzzword. Agentic AI is a fundamental change. We're moving from AI that just makes stuff, like text or images, to AI that actually does stuff. It's the engine that's going to power this whole new software economy by automating complex workflows from start to finish. And this slide just illustrates the difference perfectly. Your old AI, the generative kind, that could help you write a sales email. Cool. But an agentic AI, it sends the email. It logs the whole interaction in your CRM. It schedules the follow-up meeting on your calendar, and it automatically tells the supply chain that a new order might be coming. You see the difference? It doesn't just assist the worker, it is the worker. Okay, now here's the really counterintuitive part. This explosion of AI tools is creating total chaos. A flood of messy, unverified code that some experts are now calling work slop. But this chaos, it's actually incredibly good news for governed platforms like ServiceNow. Why? Because giant companies can't run on chaos. They need a safe, controlled environment for these new AI agents to operate in. So the more slop there is out there, the more these companies are willing to pay for a safe, walled garden. And boy, are they paying. Just look at this. ServiceNow rolled out a new Pro Plus tier that includes their agentic AI features, and they priced it at a 60% premium over their standard plan. This isn't a theory, this is hard proof that customers will happily pay up for software that delivers real, tangible, automated outcomes. So make no mistake, this isn't just some theory we're talking about. This is a trade that's actually happening right now, hiding in plain sight, if you know where to look. Stanley Druckenmiller? The guy is arguably the greatest macro trader alive. In the last quarter, his fund completely sold out of its Microsoft position, which is one of the biggest proxies for this whole hardware-heavy AI trade.
That is a massive signal from one of the sharpest minds out there that the first easy part of this cycle is over.
And it's not just him. If you actually dig into the institutional filings, you can see this quiet rotation happening everywhere. The smart money is looking past the headlines. They're selling the builders of AI, and they're buying the enablers, the software companies that will actually use all of this new intelligence.
Okay, so let's get back to that promise I made at the start. It's time to close the loop and finally reveal that fundamental valuation error that the market is making right now.
And this right here, this table just illustrates the trap perfectly. On the surface, Nvidia looks pretty cheap at 25 times forward earnings. Meanwhile, ServiceNow looks insane at over 100 times. But this is a classic textbook value trap. Nvidia looks cheap because its earnings are at the absolute peak of a hardware cycle. ServiceNow looks expensive because the market hasn't even started to price in decades of growth from this new agentic economy.
And really, it all comes down to this. Investors are using the wrong mental model. They're trying to apply old world logic to a brand new world. Buying a cyclical stock that looks cheap when it's at its peak is just a recipe for disaster. But buying a secular compounder at the very beginning of a multi-decade trend, even if it has a high multiple, that's the real value trade today.
The easy money on the picks and shovels, it's been made. The durable, long-term value is going to be captured by the software platforms that can actually orchestrate all this raw computing power. It's time to stop buying the builders and start buying the brains.
I'll just leave you with this final thought. Forget about PE ratios for just a second and think about the sheer size of the prize here. The global labor market is measured in tens of trillions of dollars. So if Agentic AI can automate just 1% of that, what is the true ultimate value of the software companies that end up controlling the operating systems for that new digital workforce? Think about that.